mining equities from a retail perspective, game on or con on? The answer is yes. And what I want to go through with you all is some of the cons that I think are obvious, but we'll get into that. But really more important, why this industry has that sort of history, tainted history. And then I want to give a bit more detail on things that I think will help you evaluate news releases, journal results, geology, and your own investments. And that's what Joe Mazumdar and I try to do in our letters, not just say, we're buying this or we're not buying that, but why, and to try and educate, give you some background so you understand what we're doing and why, and you can make your own investment decisions as well. The bottom line problem we face in this industry is that there are just not enough good, by good I mean economic deposits to go around. We've got in the order of 1,500 exploration companies, maybe 150 sell-side analysts scattered around the world, 40 firms raising money for these guys, and there's just not that many good projects. And this chart below shows the gold discoveries since, I think, 1990, and you can see a clear trend. We found a lot up here, and over time, that is the discovery rate. It's just gone down to 2013, and it's about the same for 2014. This is the line of production, gold production, which is about 90 million ounces. That's where we are today. There's a 40 million ounce gap there that's not being filled, and it hasn't been filled for quite a while. And that is really the thesis, I think, the overriding thesis that Joe and I focus on, is recognizing that it's that gap that these major mining companies have to fill. And the only way they're going to fill it is buying the very few quality deposits that come around. All right. This is a quote from a great book. Real money in mining is in dealing claims, not developing them. Flip properties before they get to the paperwork stage. Ride the wave early and leap off before it crests. If no such wave exists, it's up to the salvie promoter to create one. And that's from George Graham Rice, 1906. And there's Goldfields, Nevada. He did really well down there. He started off as a horse racing tout sheet guy, and then got into gold mining and did really well. And that's the book, My Adventures with Your Money. The golden age of the con artist. It's still here. Tout sheets and newsletters. Here's one I like. Stock Advisor says, this little tiny company, Lone Star Gold, I think it was, you can get it for around $1. And if I'm right, you can turn 10,000 into $1.25 million. This is going to happen because Goldcorp is going to buy this company. And it goes through the details of why they're going to pay $125 per share for this deposit. What's that, 1,700% profit? Don't speculate on rumors. A Goldcorp takeover of Lone Star is the real deal. You can buy this stock now for 0.18 cents. Another one, investor alert, massive gold sands deposit at the bottom of the sea. This was a really big promotion by a newsletter group out of the States, Baltimore. Gold sands, secret to making 1,000 or 1,000% from the richest gold deposit in the world. And there is a little booklet you could get by sending them an email, and they get your email address, and they pump this to you, how this gold sands is going to work. And here we go again. It didn't work. This was Nautilus. Now you'd think, all right, that was, this is the information age, and everybody's got access to all the information. The age of the con man is over. Think again. All right. So it's not just newsletters and such, But when demand exceeds supply in terms of deposits or companies, the sell-side analysts, the brokers, the bankers, their job is to sell you stock. And if demand is so high, and they're getting that situation right now, they've got to make up more reasons that a stock is still undervalued. And here's one where you can see all the major analysts were on top of this one, Allied Nevada. And Allied Nevada predicted their cash costs of production were going to be total costs were going to be in the range of $400 an ounce by 2015. And there are, legitimate analysts with targets and such on this, and I'm not knocking them for it. Things didn't go right. But it's just something I think you need to be aware of as a retail investor that what is the motivation of someone giving you this information? That's not a very good slide. You can see. Anyway, that's what happened to Allied Nevada. They went bust. All right, 43101 compliant. All right, that fixed everything. Now we're finally legitimate. And as retail investors, we're safe. I suggest not again. Rubicon's infill drill program confirms continuity and grade of the F2 deposit and continues to encounter high-grade mineralization in sparsely drilled areas. They raised over $500 million over that time frame, a few years, and you can see what's happened there. It's bust again. This is what happened with the final resource estimate versus the previous one, and the gold resource dropped in the indicated category by 91% and in the inferred by 86%. So what I think there's a misunderstanding what the 43101 is, and that is that it's not a guarantee that the data is accurate. It's a guarantee that the report followed the outline that what has sought to be in those reports. It still comes down to the group or the company producing this report or the resource estimator who's doing it. And there's a lot of variability in there. So you still got to be careful and look at what's being said and printed and told you. And here's another one, resource estimates. If at first you don't succeed, Midway's Pan deposit. In 2009, MDA out of Reno did an estimate, came up with 608,000 ounces at 0.018 ounces per ton. Not good enough. So they got another group to come in and do it. Gustafson Associates in 2011, they bumped it up to 900,000 ounces at a bit lower grade. And that cross-section through the deposit shows you the resources. They drilled another 18 holes, I think it was, and got it up nearly, added a third to the resource estimate. And they're not quite the same scale. But what they did that was different was it was unconstrained geology. So instead of constraining the mineralization to the geology, they just kind of let it float off into the distance. And that's how they got the additional ounces. The final tally, 477,000 ounces. So basically half is what the final resource estimate came back at. All right, so we bashed the letter writers, we bashed the technical report guys. Now we're going to go after the presidents of these companies. IAMGOLD. Our performance was strong in 2015, another record year, et cetera, et cetera. Net loss from continuing operations attributed to equity holders for 2015 was $797 million. I don't see the strong performance. So, it's sort of buyer beware. I think you know this, but it's important to, again, keep in mind who's saying what for why, what reason. Okay, the reality is outlandish get-rich cons prey on the naive, and they work. Industry standards don't really protect you. Cost accounting and such is confusing. Management spin, shareholders' interest not aligned with management or the sell side. Demand is usually out of sync with supply. That's a whole nother topic. Quality is the exception, really, really important. And exploration mining time frame exceeds investors. Most investors think in terms of months, if not weeks, whereas from discovery to production, we're looking at 10 years on average, I mean, it was 2010 that Kamenak first did those trenches, and I looked at it, and it's 2016 deposit was bought. Now it's probably 2 or 3 more years before it even goes into production. So we're looking at 10 years again. It takes time. These things don't happen overnight. Underlying problem. Mining and exploration are just too hard. Geology, we've got a very specialized scientific jargon that is always thrown out there, and I recognize most people don't really understand the details of it. Resource estimation, geostats, sampling, modeling, grade, tons, mining, underground dilution, production, tailings, metallurgy. Is it refractory, silica-encapsulated, concentrates, engineering, environmental work, acid rock drainage. Then you got the social and political issues and the finance. How do you do that? And the time again. I'll sum that up real quick. In short, it's an extremely complex industry that requiring numerous fields of specialization based on an inexact science and unknown future metal prices, building capital-intensive projects in isolated localities, usually occupied by unfriendly natives that, more often than not, end in failure. Yet, exploration offers the highest possible returns on speculation, thereby attracting the best and worst. You buy that? All right, so let's look at what you can learn from data that's put out here. This is a drill pattern for Sirius, and they've got a project in Quebec that looks pretty interesting. They're right up there. And what I want you to notice on this drill pattern is there's drill holes kind of going a lot of different directions across this 200-meter area. There's probably 35, 40 drill holes in there. Now, what this tells you, and I don't think they would disagree, is that as yet they haven't figured out what is actually going on here. They're getting hits. The hits are scattered. They're not joining up. So they're still trying to understand what's going on. And I think as a retail investor or an investor in this, you can look at this and say, okay, I understand they don't quite know what's going on here yet. They're trying to figure it out. But that's useful information. Another one, Columbus Gold. This is a project down in Nevada. Sort of the same thing. There's a 200-meter bar there, and there must be 60 holes in this. And again, you can see they're kind of scattered all over. The red bits are the gold mineralization they've hit, and you can't join it up, can you? To make a mine, you've got to have all the points join up. Otherwise, it doesn't work. One more, part 2. This company, Avrupa, put out a drill hole, first drill hole into this, 126 meters of 6 grams. Subsequent to that, they've drilled 47 drill holes in a 200 by 200 meter area. And again, look at the spacing, look at the pattern there. They came out with a resource a couple weeks ago, 99,000 ounces. That's it. That's the share price. All right, this is a narrow high-grade gold vein. Have a look at this. I want to change how you look at these things going forward. What you can see there is the 2 red lines point to basically the quartz vein. The green line is about a half meter apart, and this is a deposit in Northern Ireland. And so the white is the quartz where the gold is. The question is, what does this mean? How do you actually mine this? How do you evaluate something like this? So what we're going to do, and this is a little slogan I like, mine is a terrible thing to waste. And a miner's definition of, well, rocks, actually, and I think Tim had backed me up, there's only 2 types of rock. There's ore and there's waste. Nothing else matters. So what this diagram shows here is a vein dipping about 7 degrees. This is a cross-section looking at the vein. The vein is 1.5 meters wide. However, to mine this vein, you've got to mine 3-meter width. That's for this particular vein, we'll assume that's the minimum mining width. So you've got 1.5 meters diluted by another 1.5 meters of barren rock. That makes sense? Okay, so if we assume that this deposit grades 10 grams per ton based on this 1.5 meter vein, but we've got to mine 3 meters and the other 1.5 is 0, that makes your diluted grade, takes it down by half, so it's 5 grams. Sort of the same slide again, but what Last week, I think it was, Joe and I went through Dalradian and came up with a scenario. And their resource is about 2 million ounces at 11 grams at 1 meter width. But we think the minimum mining width is going to be 1.8 meters. So we've got to dilute that by 80%, which gives you a mined grade of 6.45 grams. Big difference. And you've got to recognize that when you see these resources. There's a resource, unless it specifically states what the diluted grade is and all the assumptions behind it, you got to assume that that's undiluted. All right, there's your vein again. I hope you think different about these. And that's what it looks like, not there, but somewhere else, mining underground. Mining is not as easy as it sounds, if it does. Strip ratio. Here's two examples of a zone, a vein zone, they'll call it, and the strip ratio. And the strip ratio is basically how much waste you have to move to get to the ore. And this is real simplistic. So here we've got a narrow structure, and here we've got a thick structure. To get down to the top of it is 1.7 tons of waste per 1 ton of ore. On the narrow one, not much difference. But as you go deeper, look what happens to the strip ratio. On a narrow vein system, your strip ratio jumps up to 4.4 to 1 versus the wide one is 2.0 to 1. So your strip is much less here. This is a much better deposit, and that's why. You see this a lot. And here's what it looks like in a real section, applying gold prices. So at $1,200 gold, you can mine this much. If you bump it up to 13, you take in a bit more. Bump it to 1,600, you can take it down to here. And that all has to do with how much waste you have to move to get to the ore. Real life example. Minetta Porcupine. They've got a combined 3 million ounces inferred grading 1.2 grams and an indicated 1 million grading about 1.09 grams a ton. This is a section through their deposit. The yellow is everything above 0.5 grams. So this. And the red bars there are the kind of relative gold grades. Now you tell me, how much of this is really economic? This is basically all waste to get down to this little bit down here. And this is the pit line they put on here. You tell me. One more, smearing grades. This is a great little device that myself and Corebox put together, and there's the website for it. What happens is if you take a high grade interval, you can smear that grade across a long width, and it makes it look good, like WCB put out, 48 meters of 4 grams gold, etc., including 4 meters at 47 grams. So we put this into the little calculator. There's the 4 meters, and our residual grade down here tells you that really they've got 44 meters of 0.13 grams and 4 meters of 47. Big difference. And what that means in terms of value, the reason is on a gross metal value, the 48 meters, if you average that out, is worth $183. But if you just do the 44 meters, that's worth $19 a ton. Big difference. But the implication with that long interval is that it's all running really good. Okay, I'm going to go quick. What else can you do? What does the way a company presents its data is the first screen. They need to give you everything in terms of maps, sections, data, everything. And this company, Mirasol, does a great job of it. This is just an exploration project, but look at all the data they've got. Even if you don't understand it, you know one thing for sure, they're trying to convince you and giving you everything. More data, a section with some little bits of the rocks, the core, than what it ran. Not a good example. Otis drills 95 meters of 4 grams. This was the data they gave you. It's goofy, like what the hell's that? You can't evaluate it, so there's no context there. I'll give one more example. Almaden, who's actually up here next. When they put out a news release with the drill results, they give you everything. Here's the plan map showing all the different drill holes. Then they'll give you a section through it of ones they release. That's what it looks like in the individual assays. That's what we want to see. That tells you that it's a legitimate company doing legitimate work, and they're seriously trying to interest you in their company. I'm out of time, but how a company presents itself on its website, the information it gives you, tells you a lot about the company. There's no excuse for not having a drill map section or something that goes with a news release. It's not that hard. Those are two examples. You get it. Technical reports, fatal flaws. Always look for the fatal flaw. If we know 90% of these aren't going to work, my job is always just to find that what's not right. If I can't find it, it's great. All right, so on our website, there's lots of free information, commentary. That's all I've got. I certainly appreciate your time, and good luck, eh?